Okay, here we go. All right, guys. I'm recording now. Oh, I forgot to ask you, Sally.
No,
Do
yeah,
you
I'm
want
good.
your face in it? It's okay. All right. Okay. It is October 20th. Canvas is down. Sally and I are talking about chapter 3 homework. And she just asked a good question. Go ahead and ask it again.
So there's like we look at the journal and then we figure out what's debit and what's credit, and I'm just confused. Like the first one, it's mostly like cash and common stock, but
Mhm.
sometimes one problem it says cash credit and common stock debit, but the other one is cash debit and common stock credit. So I don't know which, like, how can I actually identify which goes which? Where?
Okay.
Yeah.
That is the crux. That is what this test is about. I can tell you that. Let's bring really knowing your debits and credits. So let me bring some stuff up that we can look at. Hang on. All right. Let's see if I can bring this up. Don't scan. All right. Hang on just a minute. I want to bring up. I want to start with looking at Monopoly, even though we already did Monopoly in class. Okay.
Yep.
Because I think it will help. Okay. So this is the beginning of debits and credits. So I'm going to share my screen. So chapter 3, we really wanted you to know debits and credits. Hang on, let me get rid of the rest of this stuff. Okay, can you see this screen?
Yes, I can.
Okay. So on-campus students, you got a chart of account that was on a Word document, but my online students, when they play Monopoly, they get a chart of accounts in Excel and they do their whole Monopoly in Excel.
Mm,
But it doesn't matter. You can see debit, credit, 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 debit. And you see this accounting equation. Assets equals liabilities plus stockholders' equity plus revenue minus expense. And it's color coded. If you can see the color, both assets and expenses are increased with a debit. Liabilities, stockholders' equity, and all the revenue accounts are increased with a credit. So if you think about the accounting equation, and let's go here and look at this. If we think about the accounting equation, you can see it here. Assets equal blah, blah, blah. Normal balance increases. Assets are on the left. Okay. Debit means left. Okay. So if we debit an account like cash, we increase it. If we credit cash, we decrease it. Expenses have the same rule, debit to increase, credit to decrease. We don't usually credit expenses unless we're correcting an error. And of course, dividends the same, debit to increase. And then liabilities are on the right side of the equation. Credit has an R in it, so I made that capital. So we increase liabilities with the credit, decrease with debit. Stockholders' equity also on the right side, revenue also on the right side. Yes, expenses and dividends are also on the right side, but because they're negative, because we have that negative right there, it's the opposite. Okay.
okay.
Okay, so back to chart of accounts. Okay. So this is mostly the accounts you guys are going to be using, but we're not playing Monopoly when we do our homework or when we do the exam. So you're only going to use probably one revenue account. And it's not listed here because we used a specific revenue account for Monopoly. But what's the general revenue account that we've been learning?
Service revenue.
Correct. So that's the one we're going to be using. So I'm going to add it here just while we talk service revenue. We didn't need it in accounting. We wanted to know rent revenue, go revenue, and miscellaneous. but for our exam. Now over here for the assets, we'll have cash, accounts receivable, land, building, and then liabilities, you guys learned more than that. Stockholders' equity is only common stock and retained earnings. And then rent is all that other stuff. Okay. So let's go look at the homework. So let's go see if I can, I don't know what I can bring up on the homework. I'm just going to look at it and see what we have. So on the first homework problem, it says, which one did you have questions on? The journal entries or the short answer?
I think the journal entries. I don't know. I don't remember exactly the question number, but there's like the wording of the description and like the investment cash in exchange for common stock and all that. So there are like two problems. They're completely different. So I just don't know like what should I focus on to like identify which goes where.
Okay.
I don't know if I'm making sense for you, but
You are making sense. So let's just grab one. Transactions for Jane Company are presented below. Give me the journal entry. Okay, we don't know what Jane Company does. We assume it's service because it's chapter 4. And the first transaction is on June 1st, issues common stock. Okay. Can you see it in the chat?
yeah.
Okay.
Yeah, that's that.
Is that what you were talking about?
Yeah.
Yeah. So Jane Company issued stock in exchange for cash.
Oh,
So Jane Company received cash.
okay.
So cash went up. So debit or credit?
Debit.
Oh, good. Okay. So we're going to do debit to cash, 5,000. And then what are we going to do for the other side?
Common stock credit.
Good. So I'm going to say credit, common stock, same amount. All right. So let's see. I'll give you another one. So are you okay on the other kind of transactions?
I am okay.
Okay, okay. So purchased, so buys equipment for $1,100. So
Buys equipment for $100.
any amount, that's good.
Um, this one goes to equipment is listed under asset, so it's gonna be debit, and then cash gonna be credit 1100.
So I like your logic. You're saying, okay, I know the account is equipment. Then you're saying it's an asset. And then you're saying, what's the rule for increasing an asset? It's a debit. So you're following through the rules of debit and credit. So that's great. So debit equipment, 1,100.
But there's another thing.
But I didn't tell you if
Yeah.
you paid cash. And it actually didn't say that. It said buys equipment on account.
Okay.
I left that off on purpose. So yeah, if you don't know, if they don't tell you, assume it's cash. But if they say on credit or on account, what account are you going to use?
Account payable.
Good. Debit or credit?
Credit.
Good. Credit accounts payable. All right. So it's a lot of vocabulary that these are all words you know, Sally, but we're using them in accounting situations. So they're very specific in accounting. Pays. So if you see the word pays, and Lord. Now this is interesting. It looks like June 3rd. Pays the landlord $740 for June rent. So you pay at the beginning of the month, it looks like. So when we see pay, what do we know is involved?
cash is involved.
Mhm.
And I'm not sure if it's rent expense or prepaid rent.
Because it's in the same month, it could be prepaid rent, but we will use rent expense because it's in the same period of time.
Okay.
Because why? Because we only publish financials once a month.
Okay.
So you have rent expense. That's pretty good rent. And what's the other side? Whoops, that's the debit.
Rent ex yeah. Credit cash 740.
Good. So cash goes down. So we always list our debits first, and I can't do it on Zoom, but
Yeah.
you would indent the credit.
Okay.
Just easier to grade, and it's visually how we present it. Okay. So sends Will Wheaton a bill for $700 after completing welding work. Oh, I guess it's a welding. Do you know what welding is?
Like cleaning grass or
No, it's if you have metal and you want the metal to stick together, like
okay.
and you have a machine, not a gun, but it's like
It's
welding equipment. It makes it very hot, the metal,
yeah, and then
and
it
it comes
has
together.
light and you have
Yeah.
to like
I
cover your
can't think
eyes.
of the name of it. Anyway, welding equipment. But you wear protective covering and everything.
Yeah.
So you did some welding work for Will Wheaton and you sent him a bill. So June 12th, send Will a bill for 700. Now, this has a lot in it. So you're saying, oh, they're a welding company. They didn't say that before, but now we know. This is service. Who is Will? Is he a supplier or a customer?
Customer.
Good. Okay, so we sent him a bill for 700.
It's gonna be accounts receivable.
Good. Debit or credit?
Accounts receivable under asset, so it's gonna be debit.
Good.
And then unearned service revenue, 700.
Let me put this. Why do you assume it's unearned?
Because it's just a bill and the customer didn't pay yet.
Oh, okay. Now that's you already covered that with accounts receivable. So that's
Okay.
good. They performed the welding work, so they have earned the revenue.
Okay. So it's
We
service revenue.
good. We use unearned revenue when the customer prepays for something with cash.
Oh, okay.
So when we book the original entry for unearned revenue, it means, let's say, Will Wheaton prepays for $700 of welding work for July. Then we would debit cash and credit unearned revenue.
Okay, gotcha.
Does that make sense? Okay.
Yeah, let me just note it down. Please, before. Okay.
Let's see. The next one is more journal entries. The next one says make a, are you good with making trial balance? Good.
I am.
Okay. Okay, let's do another one. Purchased supplies for cash.
Cash credit and supplies debit.
Good. And oh, I'm sorry. I might have misheard you. Say it again. Say the debit first.
Debit supplies and credit cash. But there's another thing too. There are some problems I've gone through. They said supplies and supplies expense. So
Hmm.
that is another problem.
It is another problem. Let's take a look. It says, so you're going to use both in chapter 4. So let's say you say used, if I said used 450, purchased and used, something like that. If it's used up, if I bought it and used it up right away, I would use supplies expense. If I just bought it, but I haven't used it, it's still an asset. It's supplies.
Oh, okay.
Paid dividends to stockholders.
Pays means cash.
Yes, good.
So dividends, debit dividends, and credit cash.
Good. Okay. Oh, here we go. Now this is a good one. Received. This is a good one. I'm just going to make up numbers. $300. And I'm going to put this in quotes in case you don't know the definition. Some of these are brand new for many students. Received $5,300 down payment from a customer for services to be provided in the future.
Down payment, I think it's just like when you buy a house and the house costs like $500,000 and you down payment like 20K.
No, no, no.
No?
This is different. So when we say down payment, we mean, oh, let's say you want to go to Las Vegas or Disneyland. So you buy a ticket from Alaska Airlines. You pay it now, but you're not traveling until December.
Okay.
So they got the money ahead of time. So what happened to cash when the company receives a down payment?
It's gonna be debit cash. So
Good.
is it under unearned revenue? Okay.
And then so debit cash. Oh, so that's wrong. Debit. I don't know if you can edit these. Oh, I can edit it now. I didn't used to be able to. All right. Debit cash. What do we credit?
Credit unearned revenue.
Yeah.
Okay.
In chapter 4, we're going to see like, oh, now you took the trip. What does the company do? Now they recognize the revenue. Okay. Here's a good one too. Another good one. Received 650 payment. Sorry for typos, from a previously billed customer. There we go. That should say received. Yeah.
It's okay.
You know.
Yeah.
Go.
Previously billed customer for payment of services provided in the prior month. Provided in the prior month. So it's gonna be debit cash and then accounts receivable credit account receivable 650.
And what was the debit?
Debit cash.
Good. And credit?
Accounts receivable.
Yeah. So that's a big long description. Receive 650 payment. Okay, payment, debit cash. And then you got to read more. From a customer that was previously billed. So that means accounts receivable for payment of services provided in the prior month. So then okay, we already billed them. That would have been debit accounts receivable, credit service revenue. So now we just want to clear out that accounts receivable. Debit cash, credit accounts receivable. Now the balance for that customer is zero. They have paid their bill.
Okay.
All right, let's see. Next ones, keep looking. Lots and lots of journal entries to review.
Yeah.
Mm,
I think another thing I struggle with is the order of accounts in balance sheet.
yes, that's a tricky one. Let's take a look. I'm trying to see if I can get into the textbook. It would be nice.
Yeah.
That would be so nice. I don't know if I can. And if I do, I don't know if I can remember my password anyway.
Neither do I.
And everybody's like, I don't log in. Okay, got in. Okay.
Do you have classes today, Judith?
I do not. I have an online class and
Oh,
I'm still trying to load. We'll see if it loads. Um, my online students are going crazy because they can't get in. All right. It's still loading. I don't know if Wiley Plus is having trouble. They were also having trouble. So
so inconvenient to live without tech these days.
I know we're so dependent on it, right?
Yeah.
Okay, let's see if I can find it somewhere else. There's a good example in chapter 3, but we can't get to it. So, I mean, sorry, chapter 2. But let's see. I have one in my course pack too. Let's see, it's not that. Let's see. Ah, here we go. That is it. Okay. Oh, that's perfect. Okay, this is good. All right. There's an example in your book, but I'm going to share this screen with you. It's not, here we go. All right. Can you see this?
Yeah, I can.
Okay. So we'll start with the assets. There's 1, 2, 3, 4 possible categories. Current assets, long-term investments, not long-term assets, and then property, plant, and equipment, and then intangible assets. Under liabilities, we have current liabilities and long-term, so it's a little easier. And then stockholders' equity is the same the way you learned it in chapter 1. Okay.
Okay.
So let's look here. So order, we put cash. So order of liquidity. That means how fast it turns to cash. So we have cash, then debt investment, and that's very short term, has to be short term. Could also be stock investment, very short term.
Hmm.
These are not the company's debt. This is not the company's stock. It's from other companies.
Can you give an example for debt investments?
I sure can. So let's say you are a very rich company, you're Apple,
Okay.
lots of extra cash. You don't want to have the cash in a checking account
Hmm.
because it doesn't make any interest. So you go out and you buy, companies put debt instruments out into the marketplace and they're called bonds. So Apple buys a bond for Walmart and Walmart says, hey, this bond is due in 5 years. Okay. But there's shorter ones that are due in like 90 days. Okay.
Okay.
and we'll pay you interest. So basically, the other company's borrowing money from Apple.
Okay.
It's like putting your money in a bank account, but it's less safe. There's more risk, so you get interest.
Mm-hmm.
Okay. You only do that if you have extra cash.
Yeah.
And then, of course, accounts receivable, and we don't have inventory yet, but that's where it would be, and supplies, and then prepaid. So that's a good order.
But I think in like in other examples and problems that I went through, there are a lot more of current assets. And I'm still confused between inventory and supplies. Like inventory also stuff and supplies also like the material stuff.
Yep, yep.
So what's the difference? If I mess up in the exam, then I will lose like some stupid points.
You will lose some stupid points, right? Sorry. Hang on. Let me see if I can pull up a different one. I really want the one from the textbook, but I didn't make a copy of it. Okay, let's see. The one in your textbook is really good. It's no, it's not in here. Okay. La, la, la. Okay, I'm looking at the one in the textbook, and it has the same numbers. I use almost the same. So the difference between inventory and supplies. Inventory is things that a company buys that they plan to resell.
Okay.
For example, Starbucks has fancy cups for resale.
Okay.
Walmart has coffee machines for resale. Okay. Supplies are things the company does not sell to customers. They use them up inside. For example, printer paper, printer cartridge, pens, pencils, paper towels in the bathroom, toilet paper in the bathroom, Kleenex, things they use up.
Mm.
And they use them to run their business. So typically they might buy 3-4 months of supplies because you go to Costco and it's cheaper if you buy a lot, right?
Mm.
Inventory, we want to turn it over very quickly. We want to buy it and sell it quickly. We want to make the money from it. We don't want to buy a year's supply of inventory. So it's a little higher up on the list.
Okay.
And so it's higher because it means we won't have it that long. We're going to have it for a shorter period of time.
Okay, gotcha.
Okay. And then
That makes sense.
prepaid insurance is often for 6 months, or prepaid rent is often for 12 months, something like that.
Okay.
All right. Property, plant, and equipment. Do it in that order. Property, land, plant, any kind of building,
Mm.
and then equipment. So it tells you the order. Long-term investments, it's long-term. They have to tell you. If they have to tell you if it's short-term, if it's not, it's long-term.
Okay.
Another thing you could have is land held for investment. And real estate is another word for land.
Okay.
Okay. And then remember, put accumulated depreciation here as a negative.
Can you explain more about that accumulated depreciation?
Sure. Land does not depreciate, but buildings and particularly equipment depreciate very fast. So like you buy a computer, maybe it's good for 3 to 5 years. Okay. So let's say you buy a nice computer and you spend $5,000 on it, really nice computer. You expect it to last, maybe you're in a very high-tech job, 3 years.
Mm.
Has to be really good, really powerful for 3 years. So if you buy it for $5,000, each year you're gonna write it off 20%.
Oh,
No, not 20%. It's a 3-year life. You're gonna write it off 1/3 every year.
okay.
So the first year you say you're gonna write down the equipment, but we leave the balance in equipment at the original value. Okay.
Mm.
And the buildings, we leave them at the original value. This tells us how much we've taken off the value.
Oh, okay.
All right. So let's say you had one thing under property, plant, and equipment for $100,000. Equipment, only one account. And let's say accumulated depreciation was $80,000. Then you'd know you'd pretty much written down most of that equipment. You still have a little to go, but you've written it down most of it. It means the equipment's older.
Okay.
All right, patents,
Gotcha.
goodwill, trademarks, all of those go here.
Okay.
Now,
So
okay,
patents, so which one goes first for intangible asset?
it
If
doesn't matter,
it
Sally.
doesn't matter.
It's
Okay.
really just for current assets that it matters and current
Okay.
liabilities that it matters.
Gotcha.
Okay. So theoretically, it's an order of liquidity. Okay. But
Okay.
usually many of the intangibles have an indefinite life. So,
Okay.
so I was looking at, they don't give you that guidance in the book, so don't worry about it. You will put them in order of liquidity, but it's not in your book, so I'm not going to hold you guys to that. Now, under current liabilities, the book puts notes payable first. So let's do that. Then accounts payable, and then the rest. Okay. So typically unearned revenue, salary, wages, they're going to be towards the top. Anything you're paying within 1 year is in here. Okay.
Mm.
And then these guys would be, mortgage, long-term note, whenever. Okay.
So is there do we so we have to put the order of current liabilities in order to?
Current liabilities, yes.
Okay.
All right.
Notes payable. Why notes payable before accounts payable? Because customer.
So the assumption is you put it in the order that it's going to disappear first. So
Oh.
with an asset, you're going to use it up. With a liability, it means you pay it back, right?
Okay.
So we're going to pay that note back first before the accounts payable. So maybe it's a very short-term note.
Okay.
I've actually seen accounts payable first and then notes payable. This book puts notes payable first.
Okay.
All right. So you're asking really good questions. So yeah.
Yeah.
All right. Anything else?
Let me see. So just want to make sure retained earnings are in both balance sheet and retained earnings sheet.
Retained earnings is on the balance sheet. The ending balance of retained earnings is on the balance sheet.
Okay, so the beginning retained earning is
Not. It's on just retained
okay.
earnings statement. Yeah.
Ending.
So retained earnings is like a bridge between the income statement and the balance sheet.
Okay. So ending retained earnings are in balance sheet.
Correct.
Okay, just note it down. Um, I think it's gonna be it for now.
Okay.
As more as I go through the homework and the practice exam, then I'll have more questions for you for tomorrow.
All right. It sounds like a good day tomorrow. And
Yeah.
remember, bring your laptop tomorrow if you can. We're going to do some work on the SEC. So,
Okay.
all right.
And also for the project, it's gonna be due after the exam, right?
Yes.
Okay, because I think I haven't checked the due date yet, but anyways.
I'm going to do your contract by Friday. So we'll talk about that a little bit tomorrow.
Okay, gotcha.
Okay.
All right.
All
Thank you,
right. See you.
Judith.
Bye-bye.
Bye bye.